Hey guys, it's September 21st, 2013, and today I'd like to talk about trade the trade and not the market. So, what I'm talking about here is that you're trading the actual trade that you make rather than the market and how and which direction it's moving. Now, yes, normally the beginners or when you're first starting out, you're looking to make trades for the market to head higher. So, for example, if you're trying to get an Apple, let's say over here, you're looking for it to go higher and you're trying to catch this movement and this little run up, and that's what you're trying to do, and you don't really know where the market is going to go. I mean, a lot of the professionals out in the pit, they don't know which way the market's going to go. They're trading options on spreads, and they're trading the risk, and they're trading the trade itself rather than the market, because most people, they'll wake up and they'll wonder, where's the market going? And you don't really know where the market is going. You kind of get a feel for that over time, but in reality it can shift and change directions like it did the other day. So looking at the Dow, I have some support points in here and resistance lines, and you can see that over here it hit this resistance line right there and the market toppled down. I mean, it could be for the cause of worry, it could be for the cause of anything else, the bond prices, the Fed, whatever. It doesn't matter. The point is that everybody's trading out there and they're seeing things, and you're seeing things differently. You'll see things differently than I will, and other people will see things differently than you will. And that's perfectly okay as long as you're trading your trade. And what I mean by trading your trade is, you got to pick what vehicle or what thing you want to focus on. And as you learn to read it and you learn the movement, then you'll be able to spot the differences and the indifferences a lot better. So let's say you got into Dow Jones, or let's just call this stock, okay? Let's say you got into the diamonds over here. Right here in this region or area, and you're in it with 100 shares, and now you're looking for it to ride up. And as it rides up, then you can peel some off, and as you peel some off, you're lowering your risk because you have less on the table. If on the other hand it starts heading down, what is going to be your bet? Because you didn't know it's going to go up. You can't foresee that it will go up. You're already in the trade. So if the market started heading down this way rather than, up this way, right up here, what were you going to do? You have to have a plan in place, and you're already in the trade. But what happens is people wait and wait for things to happen based on the market. I'll give you an example of Boeing. We wait for this pullback. If we miss the move here, people may wait for this pullback to come down to here or even here. And, right now, looking at Boeing, the volume is pointing to the downside, and it may retest this level, or even this level. But the thing is you don't know when that pullback will come. It can come at any time. So if you nibbled a little bit right here in this level, let's say I entered the stock after it gapped up, and I entered here. Now I'm in the trade. I have some sort of position, and now that's my trade. I have maybe a light position, and now I'm able to trade what I have and focus on the risk ahead of me, rather than focusing on, okay, how's it going to move? How's it going to go? I know this is a little bit different than what I always talk about, because I'm always talking about spotting stocks. And yes, I want you to learn to spot the movements. I want you to learn and get a feel for where things are heading. So like here, things are breaking over, and it's better to enter it right there at the beginning because it's a safer bet. And now look at this run. If you entered it here, it's a lot safe. It's a lot less safe. But not to say that you can't trade the appropriate or proper position, because even if you get into it here or up here at the 114 level, you'll still be in fairly good shape as long as you properly manage your risk. So if you got in it right here and you set this as your stop, then you should be okay, because now you're trading the trade rather than waiting for what the market's going to do. So focus on what the trade's going to do. Okay, let's take a look at a couple other stocks that I've been talking about. Facebook, again, continues to move higher, and it's pushing that $50 mark. Things are running well and working well for Facebook. I mean, I talked about this one as it broke and gapped up higher here. Look at this volume. We went from the volume here on this level. Look at this, it declines, and now it's a lot higher. Here's your kind of moving up towards these peaks now, and people are trading it more further, and it's becoming a better stock and more attractive for a lot of other people. A lot of more hedge funds want to get into it. A lot of other investors want to get into it, and ideally you probably should have bought it right around here or even here, and now you could have got into it a little here. But if you missed the trade a little bit already, you can nibble a little bit here, or maybe wait till it breaks till 50. But you can nibble, maybe if you normally buy 100 shares, you can maybe buy 10 shares or 15 shares or 20 shares. Buy a little bit and see what happens. And as it continues to ride, you can increase your position as it bases like this further, because who knows how long it'll run. So you continue to run it. Tesla, the same thing. Talked about this one with this nice consolidation pattern. Broke again to the upside, and there it goes. Netflix, the same thing. I talked about this one. Or not Netflix, sorry, Amazon. Netflix as well, but Amazon right here. I talked about it a couple days ago, where it broke right here, this pattern, and it continued to run. Even if you missed the move over here in this region, it continued this pattern. Now it created this little resistance, broke higher, and now it continues to run. So now it's above that 300 level. So you're watching for these opportunities and things to set up, so that way you're able to trade the trade and not just the market. So let's say I got into Netflix, and it broke right here. It's breaking out, and I saw this point right here as, okay, it's breaking out. I move, and it's breaking out, and it moved well for 2 days, and then it moved down, and now I'm back to where I started. Do you hold it or do you get out? You can't foresee the future, but you trade the risk and you trade what's at hand for you. So right there, you would have gotten out. That's what you would have done, because you don't want to lose money. It's a simple math formula, very simple. You got to make more on your winning trades than on your losing trades. So if you cut your losses very short and have that stop in place, then you'll be ahead as long as you let those winners go. Now, granted, even the volume here looks higher. It went up, and you could have peeled some off really quickly. It went from 259 to 269. That's a 10-point run. I mean, that's a great run. You could have peeled half of your shares off, and then when it went back to your starting point, then you would have made some profit. So let's say for even one share, you would have made $10 right there. But you couldn't have peeled any off. 2 shares, so you would have made $20. Take $10 as profit, and then the rest would have went back down. Yes, you wouldn't have made more than $30 because it didn't come down. Your trade-off was that extra $10 because you could have made 20 if you sold here, but you don't know where the top is. So you got to trade the trade you have, okay? So that's why I always say, if it's good if you're doing the looking for the direction, then it's okay, but you got to have a plan in place and trade the trade. So here, if you see it breaking out, then right here you entered with 10 shares or 2 shares, let's just say. Stock continued higher. You sold a little bit. So again, we went up from 75 to 90, 15-point run. You made $15. And if it went back here, hit the point, and bounced off of that, you would have still held that 1 share and continued the run. If this was your stop, then you would have gotten out. If you set it just a little below there, which is a safer bet because you have that confluence that happens, it doesn't hit it exactly, then you would have been able to continue that run, and that next share could have been a $30 profit. So, and multiply that times 100 shares, 1,000 shares. What can you get? So you're going to get a lot more movement. And again, here, Netflix, break into the upside. Even though when we look at the market, we see, look at this run, but there are still stocks like the Tesla. Look at Facebook. I mean, look at the Amazon. They're moving up. I mean, Google even pushing higher on the volume here. There's a lot of stocks that are still kind of moving to that upside. Apple, though, on the other hand, look at this. Why? That volume right here. It did not move well. It went to the downside and the volume pushed lower. And this is a feel you get for the market. But let's say you entered the even if you totally went against what I normally say, because the volume pointed down and you should have actually not been in the trade, and the stock is heading to the downside here. But if you didn't know that and you assumed, okay, let's say it's going to bounce off of this 200-day moving average, you would have bought some here. It moved up. Maybe you didn't sell any. Let's say you bought 5 shares. It moved up. You didn't sell any. Now it's moving down, and now it continued to move down. I mean, your trade was off. That's it. You got to have a stop in place. If you had it went down to 446 over here. If you had 10 shares or 5 shares, that's a pretty good run from 464 to 46. It's a 20-point move. So you would have lost 5 shares, $20, $100 right there. But on the other hand, you have some sort of trade plan in place. You got to trade your trade because you don't know where it's going to go. You assumed it would bounce here, but it didn't. But here you can see Apple obviously pushed to the downside again. You got a huge spike in volume. It hit this gap point. It didn't fill the gap yet. It went with the market and it went lower. So my expectation, again, as I mentioned before, it's kind of heading lower and pushing to the downside. That's what I'm foreseeing, at least for a little bit. If we look at this huge monster run of Apple, it's kind of it went here and now it's popping back. This is maybe the 38% if you do Fibonacci, but I don't really, look at it that way. I look at my trade and I study the trade itself. So, this is here, but maybe it can come down to this 394, 400 level. If not, maybe this 420 level. Again, this is just what I see. What you see might be different. But when you put that trade on, you got to have that trade plan in place, and you have to have some sort of, trading the trade rather than just direction, because you really don't know when things will change up. Anyway, that's what I wanted to talk about today, is to just focus on the trade and managing your trade. So when you get into these stocks and they're running against you, you might have a trade to get out quickly. On the other hand, on the flip side, when you start your trade, you starting off right here, let's say on Facebook, let's say you get in right here at the 40 and your plan is to continue adding because you only went in a little bit. And then again, it breaks this, you add a little more. It breaks this, you add a little more, but then you raise your stop each time. So now if Facebook hits $45, you're out completely of everything. That might be your plan. Your plan might be to buy 100 shares here, and then, for every $2 it goes up, sell 10 shares. Sell another 10 shares, sell another 10 shares, and then raise your stop as well to the next lower stop. Everybody's trade plan is different, and you might have different trade plans for different stocks or different indices, but you got to have some sort of trade plan. Okay, I hope this video is helpful. Stick to a plan, stick to a system. That's what you want. Otherwise, how can you expect to be consistent? How can you expect to, have a target in place? You got to have a target and see what you want out of the future. If you don't have some kind of profit target, even if it's on a monthly basis, then, where are you going? You don't know where you're going. My favorite Turkish proverb is, if you don't know where you're going, any road will take you there. All right, that's kind of the wrap up for today. And remember to trade the trade that you're in, because otherwise, if you're waiting, hoping for things to pull back and come back, they may never come. I mean, just look at, Apple back in the day over here on the, let's say, the weeklies. You're waiting for the pullback here, then you're waiting for the pullback here. I mean, how big of a pullback is a pullback, right? So you might be waiting for a pullback from 77 to 600 level, and you might not never get it. So when you're in the trade, just have an early trade plan, and then trade the trade, not just the moving market. And of course, you do want to look at support, resistance, and you do want to look at the volume and see where it's pushing. But remember to also trade that trade and not just market direction. All right, that's what I wanted to leave you with today, and hope it was helpful.